Let's get this thing kicked off here. Let me get everything set. And again, thanks everybody for joining in for today's webinar. My name is Mike Whitbeck. I'm one of the co-founders of Blueprint. So if you have not went to these monthly webinars, this is not a sales demo or anything like that. What we like to do as Blueprint is we like to provide community service by doing some underwriting topics, specifically around income because that's our specialty. So my background, 31 years in the mortgage business, maybe 32, I forget this point. 1994 is when I remember getting in. I've been an underwriter pretty much all those 30 years. First year and a half, I was a loan officer processor, learned how to underwrite, switched over. So experienced a lot of these things myself and know the challenges of, keeping up on all these guidelines. So we like to kind of bring up things that have changed. Again, especially since we're an income calculation service at Blueprint Income Expert, we like to focus on those type of topics on here. So Fannie Mae just put out a update in October, and we just want to go over it and make sure that you can understand what's going on, the differences, and also if you're a current income expert client, you're going to know that our service handles it. If you're not, we're going to show you, make sure you understand the rules and things you might have missed on the announcement. So today's agenda, we're going to review the selling guide announcement, which was October 8th, which is selling guide 2025-08. In that selling guide, talked about the accessory dwelling unit, ADU, that you can now use it as possible income. We're going to go over the qualifying questions for rental income because we get a lot of that in our help box. Like, hey, how come my rental is zero? Why is it not giving me anything? Well, now there's additional qualifiers to using rental income, not just what kind of property it is or your transaction. And then we're talking about, Blueprint Expert can handle it all. So if you're current clients, you're going to see just quick show you a reminder of how this works. And if you're not, you can at least see how our system might work on there. All right, let's get into it. So Fannie Mae Selling Guide 2025-08. So I screenshotted the part that we're talking about today. And this is also, it was a very common misunderstanding about how people own rental. So kind of a little story time here for you that what I've observed and learned over the years is Fannie Mae was the outlier on this, by the way. Freddie didn't handle it this way. FHA, VA, USDA didn't handle it this way. But what you have happening quite a bit is you have these people that buy rentals. I'll raise my hand. I'm one. I have a rental property. It's the property I used to live in before I got married a few years ago. And so I still own it and I rent it out. Now, the thing about, you'll see quite commonly is people will buy real estate as an investment part of their retirement portfolio. They get their stocks, their crypto, and their real estate, right? These are nice hard assets to have, great for retirement planning. So what they'll do is they'll go out and buy a property, condo, whatever, and then they will transfer it to their LLC. Now, as you guys know, Fannie and Freddie do not issue commercial loans. I cannot, so my rental property is been transferred to my LLC, right? It's for legal protection. But in our world, it makes no difference. Like you're not really giving the property away. You're just, in theory, protecting it from a legal standpoint, not from a taxing or a mortgage standpoint. So what you would see is people would have on their Schedule E a property, or actually, let me explain this better. Let me walk through it. But basically what's happening is people go buy property and they transfer to the LLC, right? And that's what was kind of confusing from an underwriting standpoint. You can see even after I've been doing this for decades, it's still a little hard for me to kind of get out correctly. But the way you would detect it was you were underwriting the file, you would review the credit report and you say, oh, look, there's a mortgage on there. Okay, they have their primary residence mortgage with Chase or whoever, and they got another mortgage with Lake Michigan Credit Union. And that's weird. I don't see anything on their Schedule E for rental property. So I see the mortgage, and then I don't see anything on the Schedule E where you would personally own rental properties. But then you find out that they have a 1065 or 1120S that property was transferred to. Now, the reason that you could really notice those, and I'm sure you have seen these, is if you ever gotten a business return, so you see in the Schedule E that they own, Mike's Rental Property LLC, right? And it's a 1120S or a 1065. I'm like, okay, I don't see anything in the Schedule E for rentals, but I see they own this K1 type income. And then you ask for that K1 type income, the 1065 in this case, and you get it, and it's almost all blank. So lines 1 is kind of blank, but line 2 rental, or line 3 actually would be line 2, which shows some K1 income, nothing on line 3. And you're like, all right. And then you look at the business return, it'd be all blank on the front. But then they would have this 8825, and you'd see the property in there. And that's how people hand them off. So from a taxing standpoint, they would hand it off that way. And that's, they're doing it for legal and taxing purposes. But remember, Fannie or Freddie would have never issued Mike's rental business a 30-year mortgage. I don't even know if Walmart can get a 30-year mortgage, right? Because businesses don't stick around the way that people do. They don't have the longevity that we do. You're not going to form a company. Blueprint is a 13-year-old company. We are an 1120S. You'd be surprised, even after all these years and our assets and no debt or anything like that. It's difficult to get any kind of money. We don't generally need to borrow any, but we do have credit cards and stuff. And our credit cards have to be reviewed once a year to make sure that we're not maxing them out or not paying them off on a regular basis. So could you imagine the difficulty in getting a 30-year mortgage? So this is why you see the kind of contradiction. The person got the mortgage and gave it the property to their LLC or the 1065 or whatever. And that's what you see going on. Now, once you kind of flag that as an underwriter, you'd have to apply the special 1039 rental rule. Okay. So if you Google Fannie Mae rental income calculators, there's a 1037, a 1038, and there was a 1039. You should be able to Google it and still find it. And what the 1039 did was kind of applied this rule. And because Fannie Mae knew that you did not get that loan, whether it was from them or not, it didn't matter. They're held by them basically. Obviously Fannie Mae would have issued the loan. Is regards to your percentage ownership of the business, that debt was signed for by you in most cases, unless you had a co-borrower that was not your spouse, right? So maybe you had a partner, like a brother or a friend, and you both went into it together, right? But the bottom line is they weren't issuing an LLC a loan because they just don't issue LLCs or businesses loans that I'm aware of. Anyway, I'm pretty sure they're consumer only. So now you had to do this whole thing of like, well, pull it out of 1065, do the standard Schedule E calculation from the 825. When I say Schedule E, the same theory, I mean. And then if it was a loss, it was all your loss. Even if you're only half owner of the business, you had to take all the loss on that rental income or that rental loss. If it was a gain, the best you could do is wash it. So it's very confusing because you had to pull this thing out of the LLC, adjust the K1, blah, 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 blah. It could be a real headache. And we had no way of really fixing that in our automation either. So that's the challenges. But good news, that's gone away. So now they've kind of realigned with like how they're, Freddie does it. Freddie's done it this way for years. They didn't care that you finance. I guess in their mind, they're like, it's part of a business. So you have multiple people involved, and I'm sure there'd be lawsuits, et cetera, et cetera, et cetera. But the new method is you now just treat it like self-employment. All right. It doesn't matter that it shows up on their credit report. You're going to ignore that debt because remember, the debt is paid for by the business, and you can confirm that like you do any debt paid for by business, which they should be paying for it. You shouldn't see checks from, Mike Whitback to the mortgage company. You should see a payment from my business account because if I put it into a business and I'm paying for it personally, that's piercing the corporate veil. So I lose all my legal protection. So it's not very smart for me to do that. So you should see that the people are paying the mortgage payment from the business account to their servicer, whoever that is. So now you just verify that, and then you treat it like self-employment. You just go, all right, it's on the credit report. I just ignore it there. I ignore the debt because now I'm going to just look at the self-employed, confirm it's being paid by the business, and then I'm going to just look at the K1, add any depreciation from the 825 or whatever, and then I'm going to divide by 12 or 24, right? Because I need a 1 or 2 history. Now, Fannie Mae did specify in their out thing that if only thing this business does is rent properties, you can do a 1 year analysis, not a 2 year. Like the typical self-employment, you have to do, 2 years unless they have 5 years in business, et cetera, et cetera. But you can just do it 1 year with them. Now, again, these are Fannie Mae guidelines. Please read them for yourself. This is my summary and my understanding of them. I'm not Fannie or Freddie, obviously. I'm just a guy out here working in the market. But you can see it's a little bit confusing. It's a big Plinko game of stuff you have to do. But the good news is the Plinko game got much easier now that Fannie has kind of reverted to that method. Okay. All right. Second topic, ADU income. Now, just as a reminder, ADU stands for accessory dwelling unit income. Now, ADUs should only be present on a single family home. And you could have, like a lot of people. So I live near lake communities because I'm outside the Metro Detroit area here in Michigan. And we have a lot of water in Michigan, right? We're surrounded by water. We have a lot of inland lakes, and people like living by the lake. It's very expensive. And one of the cool thing about a lot of lake houses is they have detached garages. That's very common for us. And it's not that it's uncommon anywhere else, but Above the garage, they'll have a one bedroom apartment up there and they can rent it out. That's an ADU. It's a single family home. It's not a multi-unit, it's not a duplex or a tri or quad. And they have a different part. Now, some people just have like a mother-in-law unit on the back of their home. I had a friend's dad that used to have that, and you know, his dad's mom lived there, his grandmother, and she lived there, for the last 15, 20 years of her life because her husband had died earlier in life. So, and son was taking care of mom by having her living in the home, right, in a separate unit with him. So that's what an ADU is. Now, ADUs are not allowed to be wide open. Use, they're very restricted. They used to be much more restricted than this, but Fannie Mae is now opening it up a little bit because in the market, they recognize that this is another way people are earning income by having these ADUs. I don't know if you guys follow things like the FIRE movement, financial independence, retire early, or Dave Ramsey, or all these other gurus out there saying how to, make extra money and side hustle. But this type of thing is getting to be more and more common. Just like a few years ago when Uber came around, or DoorDash, right? You can make some extra money doing that with your car. Well, now you can make some extra money with your property the same way. So, but then you can see they have you have to have one unit. It's the property must be a one unit principal residence. And it's limited to purchase and limited cash out refis only. So no straight cash out refis. Getting money can be qualified, and you are limited to 30%. Now again, read the selling guide for a few other details, but this is pretty much all that's in there. It's a screenshot right from their announcement. But just so you know, you can do that now. ADUs are acceptable. All right, now the next thing, and this is what we get a lot of questions on, is I think sometimes people might have missed the qualifiers now for rental income. Now, Fannie or Freddie's had them longer than Fannie. So if Freddie did it first and then Fannie, and they're pretty mirrored. There's a slight difference between the two, but we're focusing on Fannie today. And VA, USDA, and FHA don't have these things. They're kind of a pass-fail system, just like liquidity for them is a pass-fail thing, unlike the Fannie Freddie world. So rental income requires the borrower meet additional qualifiers, and it's different than the subject versus non-subject. We're not talking about that. Like, can you qualify for an ADU on a property? Well, step one is, does it have an ADU, right? That was a property qualifier. But we're talking about borrower qualifiers, all right? So there's actually two of them. You have to know, does the person own or rent a primary residence, and can you document it? And qualifier number two is, do you have property management experience? Now, when you ask these questions, they're going to produce different results on your rental income. So let's go ahead, and I put a few slides together to kind of show you what we mean. Oh, before I move on, somebody asked me a question the other day. What do you mean about rent? And so a little quick background is what we've seen in the mortgage industry, and this probably started like 10 years ago, was called reverse occupancy fraud. Now, people think about occupancy fraud in you calling your primary, like you buying well, you're trying to buy a rental, but you call it your primary. That was standard occupancy fraud. You lied and said you're going to live there because you wanted the lower down payment, the lower rate, but you had no intention of living there. A little inside baseball for you. During my 30 plus years in underwriting, I was a quality, an underwriting auditor, and we fought repurchase demands. And I did this from 2009, 2011. So right after the 6, 7, 8 crash. So it was a lot of auditing to do. People are like, well, why would they even know that, right? Well, remember, when people move somewhere, they have to, where do I want my mail to go? So you'd be like, you commit some occupancy fraud, because sometimes the borrowers weren't aware they're committing occupancy fraud. It was the loan officers that were doing it to try to win the deal with a better rate. And so the borrower would get rent the property out that they would call their primary residence, and they would send a mailing thing. So, well, I don't live there. Here's my primary. Send me the mortgage coupons. Well, I would be sitting in the auditing, department, and the fraud department would send up, an email saying, "Hey, can you review this loan?" And, as an underwriting auditor, we'd look at it and go, "Yeah, they qualify as a primary." And then you realize, oh, they still have their primary residence. They never sold it like the app said, and they never moved. So that was occupancy fraud, right? And that's how you detect it. Because the rule is the first 12 months you buy a primary residence, you're not supposed to move without notifying the lender and getting permission. After 12 months, hey, do what you want, right? That was all they wanted to do. But now it's reverse occupancy fraud. And what they're doing is they're calling a rental their primary, like basically they want to move into something and buy it as their primary, and they say it's a rental. Well, Mike, that doesn't make sense. You can have a bigger down payment, a higher rate. That is true. But if you can't afford the PITI as a primary because your ratios are too high, if you say you have a renter, well, guess what? You only have to kind of eat the difference between what you get in rent and the actual payment. So if my payment's $1,000, I say I have a renter that's paying me 1,200, I get 75% of that. Now all I have to do is afford, like $120 for the payment. Who can't afford a $120 payment primary residence, right? That's not even like a credit card payment or anything. So that's reverse occupancy fraud. And that's become very, very prominent. So this is why they have these qualifier questions to say, hey, let's just make sure we're not getting that reverse occupancy fraud. So in this next slide, what I mean about own or rent your primary. Well, the typical fraud is you live with your mom or you live with another individual and you have no rent. I live rent free. Well, you don't live rent free. You're just kind of hiding it. So now if I look on your credit report and don't see that you have a mortgage, right? Then I will get rental property. And it's not from your friend. It's not somebody you just rented from. It has to be from a rental management company because that's an independent third party. So if you got somebody that's living in an accessory unit from their brother, they legitimately are renting, but they can't qualify, right? They're just not going to qualify. So it's got to be a rental property. Bank statements reflecting payment. You get around it, right? If you can't get a VOM or sorry, VOR, verification of rent from a management company, you can get bank statements, canceled checks, et cetera, right? This would be if your property was paid off, you don't have a mortgage, but you do have rental. So just be aware of that's what we mean by when we say, do you own? You can see it paid in full or has a mortgage on it. We can see it or rental property, legit rent from a maybe not a rental company. You have 12 months cancel checks, et cetera, things like that. Okay. And by the way, I say 12 months cancel check. It doesn't say that here. I probably would want more than one because it'd be easy to commit fraud. And if it doesn't define it, I want more than one. I'd want at least 6 or 7, right? Because again, don't take this wrong. It's just my skeptical nature as an underwriter. Look, you can set these things up and have one rent check and it's totally not legit, but it'd been really hard for you to kind of fake 6 previous rent checks or 12 previous rent checks, things like that. But that's just me. Okay. Now, what do we mean by the qualifying thing? So depending on how you answer those two questions, will tell you, can you use all the rental income, some of the rental income, or none of the rental income? It's the Plinko game you got to play. So we got a subject property, and these are all screenshotted right from Fannie Mae, so you can check it out. So it's like, okay, if the property type is the subject, and it's a 2 to 4 unit primary residence, so I live there. So of course I have a primary rental payment, right? I do own the property, and I've got property management experience. In other words, last year I rented this one property or I have other properties that I'm doing, then I can use everything the way you can do it. Like, you'd say, okay, I got the secondary unit. I want to use the $500 a month. I'm good to go. But if I don't have any property management experience, I cannot do anything with it really, right? Besides wash it. In other words, I don't have to eat the full PITI payment. But guess what? If I live there, I have to eat it anyway. So this kind of a nothing burger here that would never apply if you ask me. But if you don't live in if you've never lived, if you're buying this property, right? I guess that's how it would apply here. If I'm buying the property and I've never had, primary rental history, I could do the yellow. But if I buying the property, not refinancing it, and I don't have a current primary and I don't have management experience, well, guess what? I have to be able to buy that property with my own DTI, right? So that's how you got to figure it out. So it's quite a Plinko game you got to pay depending if I'm buying it, am I refinancing it, do I have experience, et cetera, et cetera. Here's another example, right? Same subject property, but this is a 1 unit with the ADU. Now remember, we're allowed to do ADU now, but not just straightforward. So we have to answer the first question. Do I have evidence of a current primary residence payment? Yes, of course. I live here. I've already got a mortgage on it or whatever. Great. You can use up to 30%. Oh, you don't have, you don't have a current primary. In other words, you're buying this. This is you, but you were living with mom, and well, I'm sorry. This one. Yes, I have experience. My previous house I owned, or this one I'm refinancing, but I've never rented before. Well, you can just, not exceed PITI, right? You got limitations there. And then I don't have either. Well, you can't do anything. So you can see it's just you have to kind of like think through what the scenario is. Do I already have a primary residence? Am I refinancing this? If this is a purchase, how am I handling it? And then the next one is, okay, oops. Subject property, yeah. Okay, they switched to non-subject property. Sorry about this. Like, what changed up? So non-subject property. So in other words, this is, I'm refinancing my primary and I own other rental units, right? So I got to look at it and go, all right, what do I got? 2 to 4 family, you know, primary residence, you got a yes or no. You do have property rental experience or you don't, you can't use any, et cetera, right? So you in the a couple years ago, you could just get a lease and basically qualify no matter what, rental property or not, rental experience or not. So it was, you know, ripe for fraud. I'll just put it that way, right? And I think the agencies kind of just got tired of putting a foot down. Actually, I worked for a manager at Flagstar in 2011, and her name is Marnie, I'll call her a mentor in my underwriting career. She's one of the best underwriters I've ever worked for. Very, like, she could think through problems and create rules before they existed. And I remember we had these rules in place in like 2010 and 9. She's like, hey, if you're saying you're buying 5 new rentals, you better have some rental experience. Or we're not giving you rental income because we're not playing this game of, you know, um, you watched a late night video of how to become a millionaire on other people's money buying rental income or rental properties, and you crash, right? We're not going to get involved in that stuff. Now, so non-subject property, 1 to 4. Yeah, you just bought it, you were leasing it before. Well, you got the green, yellow, and red. You got to walk through all the questions, right? So, again, just stressing that you have to really look at what you've got going on, what the borrower's situation is, and what you can use. And there. Now, our system, of course, we want to know, we are an income analysis system. So for those familiar with using this, you're on the REO tab, and these questions are right here. So my borrower has over 12 months property rental experience. Yes. Owns the rents primaries. Yes. And so now if I opened up each one of these things down here and click them open, my rental income, my final answers are also dependent, for a couple things. Do you have rent? Do you qualify? Do these all work? So we have captured them within the software, and I'll drag the software tab over just a little bit live here. So when we say the Plinko game, right? So I'll show you the Plinko game can affect, let me go, sorry about this. Let me just grab something real quick. I'm just going to create a new little one here on rental. So I'm just going to create a quick, just throw a rental property in here. It's Fannie Mae rules rental. And I'll go ahead and put a rental property in. Let's see what happens. Does our system follow the Plinko game, which, this would be embarrassing if we didn't as an income calculation company, right? So let's start here and let's not answer the questions. We're just going to do a standard, we are just going to do a standard, hey, this is not the subject and it's not the principal residence. So this is an other property, right? So other. So we see on the tax returns, which would be weird if you had tax returns, you have a rental experience. So let me just put these in here just for fun. And I'll put a PITI in here and I hit save calculate. Now you notice it's $1,000, even though, let me make sure it's actually bigger. It's about making things on the fly. Okay. So even though I've got rental income in theory, 2,000 rental minus 1,000 should be 1,000 positive. You notice we hit them with the full PITI. Well, why is that? Well, we're telling them down here, FYI, you got to qualify. We're just reminding you for the eligibility concerns. But I didn't answer the questions up here. So let's put in, I have a primary residence. Save calculate, hit that. Now I'm a 0. Well, wait a minute. Why am I not getting positive? Well, remember, this is a yellow. So before it was red because I didn't have a primary. I don't have, evidence of a house payment, and I didn't have property rental management experience, right? Rental experience. So at least I get a wash now. I don't have to hit the borrower in their DTI with the mortgage payment, right? So now it's a wash, even though it's positive. But if I give the positive to both of these things, so I have management experience, I do have a primary residence, and I come down here and save calculate, well, now I get my rental income, right? Because now I qualify for it. And so our software, I'm just showing you, does the same thing. And, a lot of people will be on here and they're not clients of ours. That's why we kind of teach you how to do it on your own. Just remember, that's how you have to walk through everything. All right. So hopefully that's been helpful. And I think that's it. Yeah. So any questions, you can email us at info@getblueprint.io. If you're not a client, come on over, getblueprint.io. We have a free trial. I mean, it's good for a year. We give you like 50 credits and you can kick the tires on for a while. Obviously it's got limited controls or features because it's free, but you can try it out. No money, no credit card, anything needed like that. But all right, well, I'll tell you what, I will go ahead and pause the recording, but I